Franchise valuation with growth and multiple-based valuation. Lecture 16. Lecture outline. Hello, welcome to Lecture 16 of Equity Master Secrets. In this lecture, we continue our discussion on valuation. So the first thing we'll do is we'll recap asset-based valuation and earnings power valuation, which we talked about in previous lectures. And then we'll move on to the next topic of this lecture, which is franchise valuation with growth. So we've already looked at franchise valuation, and now we're going to add growth to this model. Then we'll summarize and compare the three valuation methods. Then we'll talk about multiple-based valuation, which is a different approach to valuation as compared to the other three. In particular, we'll talk about the price-to-earnings multiple approach, which is one of the most commonly used multiple valuation approaches. Then we'll summarize multiple-based valuation, and after that we'll conclude. Okay, let's get started. Recap of ABV method liquidation value. So in the previous two lectures, as we mentioned, we discussed the asset-based valuation, or ABV, and earnings power value method. And in both of these methods, we did not lay any emphasis on growth in future earnings. So in the liquidation method, growth in earnings actually destroys value. So let's think about why that's the case. Well, suppose we have a cost of capital of 12% and a return on capital of 10%. It means that it's costing you more money in order to generate your investment, and you're returning less than what it's costing you, right? So it means that, for example, if you were investing 100 rupees, you would be earning a return of 10% on it, which is 10, and you'd be paying back 12 because that's your cost of capital. So you're actually losing 2 rupees per 100 of invested capital. And in this sense, the more you invest, the more you end up losing, right? It's essentially saying that you're putting in more than you're actually making out. So the smart thing to do in this situation is actually not to invest at all. So typically, when we're looking at buying these types of companies, we value them at their asset-based value, right? So we're kind of saying, well, if you were to liquidate the company, what would it be worth? And the reason we do that is because we know that there's no real growth from earnings at all in the future, right? They're actually losing value by continuing to invest. So if we wanted to buy companies like this, we would need to buy them at a huge discount to their asset values, right? So that's the only way we can really see that a business like this would be valuable, right? Because it's certainly not valuable on the basis of its earnings. And given that its cost of capital is higher than its return on capital, the sensible thing to do for a company like this would simply be to liquidate its assets, right? It doesn't really make sense for the company to continue operating under these circumstances. Alright, so that's the ABV method of liquidation value. Recap of ABV method replacement cost. So now we'll go on to talk about the next asset-based valuation method that we looked at. Again, we've looked at this in the previous lectures, so this is just a quick recap. When we use the replacement cost method, we assume that the cost of capital is the same as the return on capital. Right, so in the previous example, we had that the cost of capital was more than the return on capital, right? So the company was actually destroying value by operating. In this case, we're going to assume that they're the same. So the company is neither creating nor destroying value when it operates. So it means that for every 1 rupee we invest in the business, it'll be valued at exactly that, 1 rupee, right? Because the capital doesn't get destroyed, because the return and the cost of capital are the same. So the intrinsic value of the business will increase at the same rate at which capital invested in the business increases. So for example, if the capital base of the company increases by 100, the intrinsic value will also increase by 100. So let's think why this might be the case, right? Suppose you invest 100 in this company, and the company goes out and invests that 100 to run its operations, and it earns a return of capital, for example, of 10% on that 100, and then it also has a cost of capital which is also equal to 10%, so it has to pay back that 10% to its investors. So the company is left with the same 100 that it started out with, right? So when we increase the capital base by 100, the intrinsic value also increases by 100. Now, in contrast, if we look at the liquidation method, in that situation, the company is actually losing money, right? In the sense that its invested capital is falling as the company operates because its cost of capital is bigger than its return. So in that situation, we would only value the company at a significant discount to its assets value, right? So for example, for every 100 rupees invested, we may value this at around 80 rupees. And so this is kind of the difference between the liquidation method and the replacement cost method, right? And it's all to do with, what is the relationship between the return on capital and the cost of capital. Recap of EPV method. So the third valuation method we discussed was the EPV, or earnings power value method. And the main assumption that we make in this situation is that the return on capital is higher than the cost of capital. So in the previous two asset-based valuation methods, we had one situation where the return on capital was less than the cost of capital, another when they were both the same, and in this case we have the return on capital is higher than the cost of capital. But we did not take into account growth in earnings. So we were only looking at current earnings, right? So return on capital, which reflects current earnings, without considering future earnings. And by assuming no growth in earnings, we then derived a formula to value this type of firm. The intrinsic value using the EPV method gives a higher value than the ABV method for the same capital base. So essentially, if we use EPV, we'll end up with a higher number or a higher valuation as compared to ABV. And this makes sense because when we use EPV, we are assuming a higher return on capital compared to the cost, right? So that's being taken into account in the calculation. Whereas with the ABV method, we're either assuming that they're the same or we're assuming that the returns are lower than the cost. And the reason for this is, as I just discussed, and we call this a franchise, right? So the presence of a franchise, it means that the fact that the firm has a franchise means that it can earn greater than the cost of capital, right? It can earn returns that are higher than the cost of capital. And of course, the key thing to remember in this situation is that it has to be a sustainable franchise, right? So when we use this method, we're kind of assuming that the firm will earn more than its cost of capital into the indefinite future. So it needs to be a reasonable assumption. So we have to have a good reason to believe that this firm can continue to earn returns that are higher than the cost of capital, even in the long run. Okay, so that's the EPV method. All right, now we have looked at the three valuation methods. We've recapped the three valuation methods. We'll now move on to the topic of this lecture, which is going to be franchise valuation with growth. So with this, as I said, we will now move on to our last valuation method. Franchise valuation with growth. Now imagine a business that has a franchise as well as growth in earnings. So remember, a franchise means that the business is able to earn greater than its cost of capital. And growth in earnings means that we're assuming that earnings are growing over time rather than staying the same. So essentially, we have a business that has a return on capital comfortably higher than its cost of capital, okay? And it is also seeing its earnings grow at a decent rate. So this is obviously a very good situation for a business, right? So you can imagine that we'll value this type of business higher as compared with the EPV method, right? Because now we're assuming that earnings are growing, whereas previously we were not doing that. So as I said, such a business will be valued higher than the one with the franchise, but with no earnings growth, right? So really we want to see, well, what does the earnings growth add to the valuation? So growth requires investment, and on this investment, the return on capital will be higher than the cost of capital. So typically, if a company is earning a return higher than its cost of capital, and it wants to grow as well, then it needs investment in order to do that. And it'll be a good decision for the company to invest because they will be earning a return on capital higher than their cost of capital, and this will ultimately drive their long-term growth in earnings. So the company's capital base will go on increasing, and this will cause it to be valued higher than the firm with no growth, or the EPV method. Right, so essentially what happens when a company's earnings are growing over time? Well, its capital base is increasing, right? Because in order for it to grow, it needs to invest more over time. And because it's earning returns higher than the cost of capital, they end up growing their capital base. And this is what we're going to capture when we try and do franchise valuation with growth, right? So we're going to capture the fact that the company's earnings are growing and their capital base is growing in order to actually create those higher earnings. Franchise valuation with growth. So now what we are going to do is we are going to arrive at a valuation method for a firm with a franchise as well as growth in earnings. And we'll kind of talk through the logic of how we come to this, so that when we actually get to the end formula, it'll make a lot of sense, why it is the way it is. So the first thing let's do is let's start with the formula we use for the EPV method, and we can build on that. So if you remember, we had the following formula. The EPV is equal to adjusted earnings times 1 over R, right, or adjusted earnings divided by R. And R here refers to the current cost of capital, right? So remember, now this is going to be the valuation for a firm when we're assuming no growth in earnings. So now let us introduce 3 more variables in the equation. We have C, ROIC, and G. So C will be capital, ROIC is return on invested capital, and G is growth. So C is the capital base of the company, right? It is a total tangible invested capital of the business. So it's how much the company has invested, how much capital they have invested. ROIC is the return on invested capital. And the way we calculate this is that we take EBIT, which is earnings before interest and taxes, and then we adjust it for taxes, so we multiply it by 1 minus the tax rate. And then we divide it by C, which is the capital base, and this gives us the return on invested capital. And the EBIT that we're using here is going to be the adjusted earnings that we used in the EPV formula. Right, so when we did the adjusted earnings, we adjusted for certain items, specifically one-off items that we don't think are going to be sustainable over time. So we have an adjusted earnings formula, and we would want to do the same thing in this situation, right? Take adjusted earnings and multiply it by 1 minus the tax rate. And finally, G is the expected growth rate of the business from now until perpetuity. So what we mean here is that we expect the company's earnings to grow at a constant rate G, and we expect this to continue into the indefinite future. Franchise valuation with growth. So now let's go back to some of the couple of basic formulas in finance, which we're fairly sure that you've seen before and are familiar with. So here we have the perpetuity and the perpetuity with growth formula. So this is saying, well, if we have, in the case of the perpetuity, we have a cash flow CF, and this is going to be repeated into the indefinite future. How do we value that? Well, we take CF and divide it by the discount rate R. And alternatively, if we have a cash flow with growth, or a perpetuity with growth, we take the first cash flow CF1 and divide it by R minus G. So this is the formula for the value of a perpetuity and a perpetuity with growth. And in order to arrive at these, you could actually just write it out, like say the first cash flow, the second cash flow, and then this would just become the sum of a declining geometric series, which would condense to these two formulas. So in the first one, the numerator stays constant, right? We're saying that there's no growth in the cash flow, and or it does not grow for an infinite period of time, right? We assume that the terminal cash flow, for example, is constant. And in the second, we have that the numerator is going to grow at a fixed rate every year for an infinite period of time, right? So in this case, the growth rate is G. So if CF1 is 100, then CF2 will be 100 times 1 plus G. And CF3 will be 100 times 1 plus G squared, and so on. Now for the EPV, we used a formula similar to the perpetuity method because there was no growth, right? So for the EPV, we had adjusted earnings divided by the discount rate, which looks very similar to CF divided by R. And because we have no growth, then that becomes the valuation formula. So now with our franchise with growth method, since we are assuming a fixed growth rate g, our denominator will be r minus g instead of r. Okay, and r here is the cost of capital, and g is the expected growth rate of the business from now until perpetuity. So r minus g makes the denominator smaller as compared to just r, right? And that means the valuation is bigger when we have g. So by having the denominator as r minus g, whenever g goes up, the valuation also goes up. Franchise valuation with growth. So now let's move on to the numerator of the valuation equation. So in the EPV formula, we had the adjusted earnings in the numerator. So this was after tax and also took into account the maintenance depreciation outgoings for the company. And this adjusted earnings can also be written as C times ROIC. And this is the capital base of the company multiplied by its return on invested capital. So why is this the case? Why does this work? Well, if you think about how much do we earn, right, or what our adjusted earnings are, it's just going to be their capital times the return on that capital, right? And that tells us how much we're earning. So let's look at an example of this. So suppose the capital base is 100 and the return on invested capital is 15%. Then the adjusted earnings is equal to 100 times 15%, or 100 times 0.15, and this gives us 15. So ROIC, C, and adjusted earnings are the three variables in the equation, and the third can easily be found out if the first two are given. Right, so we have these three variables, and they're all related by a particular formula, and if we know two of them, then we can already get the third. Right, so in this case, we're saying if we know return on invested capital, and we know the capital base, then we can work out the adjusted earnings. And you could do the same if you had two of the other ones to work out any of the third. Okay, so this is going to kind of lead us to, coming up with what the denominator value is for the franchise valuation with growth method. Franchise valuation with growth. So now it's time to bring growth into the equation. C times ROIC, which is just equal to adjusted earnings. This will remain in the numerator for an equation with no growth, as we saw in the EPV formula, but what happens when we bring growth into the picture? How does this numerator change? So the growth requires investment in the capital base of the company, right? So the one thing that'll be the case is that if the company is growing, then the capital base is not going to stay the same. So if, for example, we have return on invested capital that remains constant, for a 10% growth in adjusted earnings, the capital base also has to increase by 10%, right? So assuming that ROIC stays the same, then in order for us to see growth in earnings, we need to see the same growth in the capital base. So this investment in growth, it will essentially have to come from the cash flow that the company generates, right? So for the company to actually grow its earnings, it needs to grow its capital base. And where does that capital base come from, or that additional capital base? That's going to come from the adjusted earnings of the company, right? So the company will, in a particular period, it will have a certain investment, it'll earn a certain return, and then in order to grow that business, it'll use its profits or its earnings in order to increase its capital base for next time and create even higher earnings. So as a consequence, the funds for growth will come from the adjusted earnings of the company. So we can get the funds that we required for growth by the formula C times G. So essentially, if C times G tells us, is the growth rate times the capital base, right? And that's going to be what we have to increase the capital base by, and these will be the funds that are required for growth, right? So if the capital base grows by 10% or G%, then earnings will also grow by the same, right? So both need to be multiplied by G, and we'll use this, as we'll see now, in order to get the required growth for the company. Franchise valuation with growth. So one thing to note here is that we have taken the ROIC to be constant, so the return on invested capital is the same. So for that reason, in order for 10% growth in earnings, we need 10% more capital base. Okay? So let's say the capital base is 100 and the expected growth is 10%. The extra capital required will be 10, right? So that's going to be 100 times 10%. And this will be calculated by the formula C times G. Or suppose another example, if the capital base is 500 and the expected growth is 15%, then the extra capital for growth under a constant ROIC will be 75, which is simply 500 times 15%. So as a result, the numerator of the valuation formula will no longer have adjusted earnings. Okay, so we're not going to be putting the earnings in the numerator, and that's because some of those earnings need to be invested in order to continue to grow the business, right? So that earnings actually doesn't represent the cash flow to investors. It's the earnings, and we have to first take away the amount that the company is investing in order to grow its earnings. So in the numerator equation, we'll now have C times ROIC, right? So that's the adjusted earnings. And we'll subtract the amount that the company has to invest to grow its capital base, which we calculated as C times G. And this equation here now represents what is left after investing for growth. So, if we recall, C times ROIC is nothing but the adjusted earnings of the firm, or the cash flow for a no-growth firm. C times G is the extra capital required for growth, right? So the formula then is just the cash generated minus the cash invested, right? So C times ROIC is what the company earns, C times G is what they invest. And the difference between the two gives us the final distributable cash flow. So it kind of still similar to our old valuation equation when we saw, CF divided by R minus G. We're basically taking the final cash flow that's left for investors after investments have been made. And this gives us the valuation. Franchise valuation with growth. So now let's put this all together to come up with our final valuation equation. So in the numerator, we now have a distributable cash flow, which under constant ROIC is growing at a fixed rate G every year. And in the denominator, we have a perpetuity that's growing at the same fixed rate G. Okay? So we've worked out now what our denominator is and what our numerator is. So what will the final formula look like? Well, we're going to have the PV, the present value, or this is just the value of the company, is going to equal C times ROIC minus C times G, right? So that's the earnings minus invested capital, right? Or the distributable cash flow in the numerator. And the denominator is going to have R minus G, right? And the denominator is going to represent the fact that these final cash flows are growing at a rate G over time, and the cost of capital is R as well, right? So that's the discount rate minus the growth rate. And then we can simplify this equation to C times ROIC minus G divided by R minus G. And we just pull out the C of the numerator, and that gives us ROIC minus G. So this, you can see, is a nice equation, right? Because it kind of tells us, shows exactly how the company is valued, and you can sort of see what happens when different variables change, right? So in order for this to be a good company, we need ROIC to be bigger than R, for example, right? And then the higher G is, typically the higher the valuation is as well. So we have borrowed this terminology for most of our discussion on valuation from Professor Bruce Greenwald's famous book, Value Investing. So PV in this case refers to the present value of future cash flows, and hence the term. The formula for PV shows us the way in evaluating firms that not only have a competitive advantage, but also have strong earnings growth going for them. Right? So remember, this valuation assumption assumes that return on invested capital, ROIC, is bigger than R, the cost of capital. And we also assume that the earnings are growing, so we have a positive G, right? And then this formula then gives us the present value of the firm. franchise valuation with growth. So now let's imagine a hypothetical scenario where we have two firms having the same capital base, return on capital as well as the cost of capital. But the only difference is the growth rate between the two. Right? So the two firms have identical C, capital base, identical ROIC, return on invested capital, and identical R, the cost of capital. The only thing that's going to vary is G, the growth rate. So how does this affect the relative valuations? So suppose firm A is not able to grow its earnings, but firm B has a sustainable constant growth rate of around 5% for many years into the future, or we assume that this growth rate will continue indefinitely. Let us try plugging in these numbers in the two formulas for the EPV and PV respectively. So suppose ROIC for both companies is 20%, capital base is 100, and R is 12%. Now let's see what the no-growth firm, what the valuation is. So first we need to substitute the values into the formula. So we don't have, G is equal to 0 in this case, so it's simply C times ROIC divided by R. And this is just the EPV formula because C times ROIC is adjusted earnings, right? So it's just adjusted earnings divided by the discount rate. So if we take, using our numbers here, so we have 100 for the capital base, return on capital of 20%, so 100 times 0.2, divided by 12%, so divided by 0.12, and this gives us a valuation of rupees 167. So the earnings power value of the firm in this situation, for the firm with no growth in earnings, is rupees 167. Okay, and next we'll then look at what happens for the company with growth in earnings. But one thing to note here is that in this case, because we have no growth in earnings, the valuation formula just reduces to the earnings power value method. And this kind of should be comforting or reassuring because if a company has no growth in earnings, then both the formulas should give us the same thing, right? In order for them to be consistent with one another. So it kind of tells us that our valuation formulas are good and they are consistent and they do work. Franchise valuation with growth. So now let's look at firm B, or the second firm in this example. And firm B, as we said, is identical to firm A in all respects except for their growth in earnings, right? So we'll assume that firm B has growth in earnings at 5% per year. And we'll use the equation that we just developed in order to value it. So we'll use the equation that the present value is equal to C times ROIC minus G divided by R minus G. So then if we take 100, which is the capital base, we multiply it by the return on invested capital, which is 0.2, minus the growth rate 0.05, and divide it by the discount rate, or their cost of capital, 0.12 minus the growth rate 0.05. We calculate this and we get the firm's intrinsic value is 214 rupees. So this is quite a significant increase, right? So for a firm that has a franchise, or in other words, where the return on capital is higher than the cost of capital, growth in earnings will create a value greater than where there is no growth in earnings. Right? So one of the key assumptions for this to work is that we need return on invested capital to be greater than the cost of capital. Right? Otherwise, investments actually create negative cash flow if it's the other way around. Right? So it's important to remember that this works particularly for a firm that has a franchise, and this will create a value greater than when there is no growth. So in the case that we just studied, the intrinsic value of the firm where there is a franchise as well as growth is nearly 30% higher than the firm with the franchise but no growth. So this additional growth in earnings really makes a big difference, right? And that should make sense to us because, as investors, ultimately we care about the company's earnings, which will, after invested capital, that's what accrues to the shareholders, right? To the investors. So we're going to value a firm higher if a firm that has growth as compared to a firm with no growth, provided, of course, that the return on invested capital is greater than the cost of capital. Franchise valuation with growth. So let's now play around with this formula a little bit. and we want to show some caveats perhaps of a company with high growth and earnings. So suppose we take the return on invested capital down to just 10% and keep everything else constant, right? So now we have a situation where the return on invested capital is actually less than the cost of capital, right? So we have the cost of capital was 12%. What happens to the valuations? Well, the earnings power value, right? So where we assume no growth, we get a value of rupees 83. And the present value, where we do assume growth, gives us a value of 71. And now this might seem strange, right? The company that actually has growth in earnings is valued less than the company that has no growth. So, like we said, the present value, which takes into account growth, came in lower than the EPV where there is no growth. Right? And I kind of hinted at why this would be the case earlier, but let's see why. So growth only adds value when the return on capital is greater than the cost of capital, or where there is a sustainable competitive advantage. So what this is saying is that if we have a situation where the return on capital is less than the cost of capital, right? So the company is earning less than what it's costing it to invest. That means it's destroying value, right? It's actually destroying value for the company. And the valuation formula picks this up, right? So the valuation formula says that the company with growth is actually worth less than the company without growth. And this will be the case when return on capital is less than cost of capital. So we can conclude that growth adds value only when the return on capital is greater than the cost of capital. And in other words, when we have a sustainable competitive advantage. So what does this mean in practice? It means that if you see a firm that has growing earnings at a strong pace, but there isn't that competitive advantage, okay? So there's not necessarily the idea that the return on invested capital is going to be higher than the cost of capital. That growth in earnings is not necessarily worth much to us, because it actually destroys value, right? So in this case, it would be better to not invest in this company. The only exception would be that if it was trading to a significant discount to its asset value, right? And then we might want to use the liquidation value method to value it. Franchise valuation with growth. So let's look at the ratio of the present value to the earnings power value at different levels of ROIC, R, and G. So this is looking at, well, what is the ratio between the valuation of a company with where we include growth in earnings, that's the PV, and EPV where we don't have growth in earnings. So let's take a look at this table below. Alright, so suppose in the first column, right, we have the ratio is 1.0, right? So this means that return on invested capital divided by cost of capital is 1, or that they're both the same. So in this case, growth, it doesn't really matter what the growth rate is or the cost of capital is. They'll all get the same. Both methods will give you the same value. So G divided by R is going to be the growth rate divided by the cost of capital, right? So what's the growth relative to the cost of capital? So the higher this is, that means the higher growth is relative to the cost of capital. So you can see in the first case that it doesn't really matter. It's always going to be 1, the ratio of PV to EPV. But as we move down each column, we see that the ratio of PV to EPV starts going up as the growth rate gets relatively larger, right, compared to the cost of capital, right? And in both cases, as G over R gets bigger, and also as ROIC over R gets bigger, we have that the PV method gives us a significantly higher valuation as compared to the EPV method. So one thing that we can see here is that even if we have a very high return on invested capital, ROIC, and we have high growth rates in relation to the cost of capital, the maximum one should pay over for a firm over its EPV is about 3 times, right? So that's in the last case over there, the lowest rightmost cell. So we would never really be paying more than 3 times a firm's EPV, and that's under quite good scenarios, very high ROIC and growth rates. So actually most companies aren't able to command that level of valuation. So in order to have ROIC over R be very high and be growth to cost of capital also very high, It would have to be sustaining, a very large advantage over a long time. And because of competition and companies entering the market, this ultimately brings down growth rates and brings down return on invested capital. Right? So even this 3 times EPV is a very high number generally, and we would never really go above that. Most of the time we'll be below that. So this now brings us to the end of discussion on the third and final method of valuation. Summary of the 3 valuation methods. So let's recap. We now have 3 methods of valuation. Okay, so the first one we looked at, it was the asset-based valuation, where we value the stock based on its liquidation value or replacement value. And this is where we have a situation where a company is earning less than its cost of capital for the liquidation value or equal to its cost of capital for the replacement value. The second method is the earnings power value, or the EPV method. And in this case, we assume a value of a franchise. So we suppose that the firm is earning return on invested capital above its cost of capital, but we assume no growth in earnings. And finally, we have the present value method, right, where we're saying that a company has a strong franchise, meaning that they have return on invested capital bigger than their cost of capitals, and they also have a growth in earnings. Okay, so those are our 3 valuation methods. And one thing to keep in mind, about the present value method, which we've been talking about mostly in this lecture, is that the growth rate, we're assuming that that's a perpetual growth rate, that's going to grow perpetually over time. So it's, in some ways, it can be a strong assumption. So we really need to be quite sure that if a company has growth in earnings, that there's good reason to believe that this growth will carry on for a considerable length of time in the future. Summary of the 3 valuation methods. So here we have an image which we think nicely demonstrates the 3 different approaches, looking at the slice of value. So essentially we can break it up into 3 things, right? We have the asset value, we then have the earnings power value, and then we have the value of growth. So the first case asset value, all 3 methods. So if we have 3 squares in the bottom next to asset value, saying that each of our 3 valuation methods incorporates asset value. And this, we use the reproduction cost of assets. It assumes free entry to the market and no competitive advantage. And then the next 2 methods, so the EPV and the PV method, incorporate earnings power value. And this is the franchise value from the current competitive advantage, right? So the current competitive advantage is reflected in a return on invested capital that's higher than the cost of capital. And finally, the PV method takes into account the value of growth. So in this case, we have growth that is within the franchise and benefits from the competitive advantage. Then we would add that to the valuation. Okay, so this chart hopefully gives you a nice intuitive overview to how these 3 valuation methods work. And in terms of understanding what's the right way or which one to use, you should really go by the assumptions that we're making for each of the different types of models, right? So in the case of asset value, we make an assumption that the return on invested capital is equal to the cost of capital or less than the cost of capital. In the second case, we're assuming higher returns than the cost of capital but no growth in earnings. And in the third case, we're assuming higher returns than the cost of capital plus growth in earnings. So we really need to use our judgment for a company to see which one is the most sensible, right? And we need to be forward-thinking as well, so we need to kind of look at, what do we expect in the future? Especially when we're thinking about competitive advantage, is it sustainable over time? Growth in cash flows, is that sustainable over time as well? So, there's considerable often leeway in when we use these methods, but we need to get the underlying assumptions right, and then this will lead us to the right valuation method to use in each situation. Summary of the 3 valuation methods. So there's a good Warren Buffett analogy that we'd like to use that will describe the 3 types of businesses we discussed using the 3 different valuation methods. So the first type is called a gruesome business, which obviously doesn't sound very good, and that's there's a reason behind that for sure. So a gruesome business is the kind of a savings account which pays an inadequate interest rate, right? So suppose you put your money in an account and you don't earn what you should earn, and this would be a gruesome business. And the way we value this type of business is using the asset-based valuation method. Alright, so this is a situation where the return on capital is less than the cost of capital, hence the gruesome business where we have an inadequate interest rate. And when we have the situation, we essentially use the asset-based valuation method, right? So that's either liquidation value or reproduction cost method. The other type of business is a good business, right? And that's one that pays an attractive interest rate. And the good business can be valued using the earnings power value method, right? Because when we're earning more than the cost of capital, right, then we want to take that into account. So we use the earnings power value method. And for that reason, we would call it a good business. Summary of the 3 valuation methods. The final type of business is the great business. And a great business is a type of savings account that pays an extraordinarily high interest rate that will rise as the years pass. So this is the situation where we also have, in addition to a franchise value, we also have growth and earnings. Okay, so this is a kind of a nice way to think about the 3 different types of valuation methods and the 3 types of businesses it would apply to. Right, so the gruesome business, where the cost of capital is above the return on capital. The good business, where we earn higher than the cost of capital, our return is higher than the cost of capital, but there's no growth in earnings. And finally, the great business, where we have the franchise value and also growth in earnings over time. As per Warren Buffett, the more sure money tends to be made in the first kind of business when it is bought at a significant discount to the company's liquidation value or replacement cost value. So let's think about why this might be the case. Well, because the assets are kind of easy to see, right? They're already, documented and on accounts, and they're generally not too hard to value. That way, if we can buy it at much cheaper than, let's say, its liquidation value, then the chance of us realizing a profit is quite good, right? So there's more sure money tends to be made in this kind of business. However, the big money tends to be made in the third kind of business. That's a great business, right? And that's where the company has a sustainable competitive advantage or franchise which is backed by growth in earnings for many years to come. So the reason we can make more money in this type of business is because obviously growth in earnings over time will lead to significantly higher stock prices over time. So we can make a lot more with the third type of business. However, there's more risk involved in this type of business, and the reason for that is because we don't know for sure whether the company will retain its competitive advantage or growth in earnings will continue as long as we think it will, right? It is more dependent on what happens in the future, whereas with the first kind of business, it's kind of already what's on the balance sheet now, so it's more sure money. So, this is kind of a good, fairly good example of the risk-reward trade-off that we tend to face when investing. Multiple-based valuation approach. Despite the practical utility, the valuation methods we've talked about so far seldom get quoted in company research reports. And instead, what we tend to see is a lot of multiple-based valuations, for example, price to earnings, enterprise value to EBITDA, or price to book value. So, like our 3 approaches that we've discussed so far, these multiple-based methods are not another set of independent methods of valuation. So we're going to talk about multiple-based valuation, okay, and we're going to tie it to the 3 types of methods we've already talked about so far, because they're actually not independent of one another. And these are really just a variation of the 3 approaches that we've already discussed, and this includes some additional assumptions and simplifications in order for us to make multiple-based valuation. So really our approach to multiple-based valuation is to kind of take it as an extension to what we've already discussed so far. So looking at the original approaches to valuation, we can easily derive the multiples that can be assigned to companies in the multiple-based approaches. So what we're going to do, we're going to discuss one of the most common methods of valuing companies, that is the price to earnings method. It's the PE ratio. So before that, let's just take a step back and understand what a multiple-based valuation approach means. So a multiple means that we're looking usually at 2 different things, and the ratio between them, or that's the multiple. So for example, price to earnings is the ratio between the price per share to the earnings per share of a company. Price to book value is the price per share relative to the book value per share. And then we also have enterprise value to EBITDA. So these are different examples. And these are all, ratios of two different things, one to the other. And typically, not always though, but it's often the case that one of those variables will be a market-based variable, so based on the company's price in the market, and the other will be an accounting-based variable, so what is in their financial statements. Okay, so let's now go ahead and look at the price to earnings method. Price to earnings multiple approach. So when we're thinking about price to earnings, so we understand that price to earnings ratio means the market price per share divided by the earnings per share. Okay, so you can kind of think of it as how many rupees are you paying for 1 rupee of earnings, right? So if the PE ratio is 20, it means that you're paying 20 rupees to get 1 rupee in earnings. Okay, so that's kind of the way to think about it. And often what we want to ask is what is the ideal PE multiple for a stock, right? So a good way to we use this, the way we often use this is that if the PE ratio is very low, that indicates a good buy, I guess, because it means that you're not paying very much for a given level of earnings, and vice versa if the PE ratio is high. So one thing we want to do is come up with what is the ideal PE multiple for a stock. So let's look at the 3 valuation methods that we have. So with asset-based valuation, we value a company based on its assets, and earnings are not considered at all. The PE ratio does require that we give a certain multiple to the earnings of a company. Because asset-based valuation doesn't use earnings, we cannot use that to come up with the ideal PE multiple for a firm. So let's turn our attention to the second of the 3 methods, the earnings power value method, and see if we can use this to come up with an ideal PE multiple. So you could recall here that we assume the company's return on capital is greater than the cost of capital, and we're also assuming that the company has a stable earnings profile with no growth. The formula for earnings power value was to take the adjusted earnings and divide it by the cost of capital, R. So in order to arrive at the PE for such kind of firms, all you need to do is know the cost of capital of the firm and also calculate the adjusted earnings. So really it's a fairly straightforward exercise if we have the earnings power value, because the earnings power value is essentially telling us what is the company worth, right? And if we were to divide it by the earnings, that would be the PE ratio, right? So the value which is the price per share divided by the earnings, that gives us the ideal PE ratio. Okay, and that's actually equal to 1 divided by the cost of capital, right? So if we take 1 over the cost of capital, if we believe the EPV assumptions that the company has a higher return on capital than the cost of capital, and the company has a stable earnings profile with no growth, we essentially have the reciprocal of the cost of capital as the ideal PE ratio. Price to earnings multiple approach. Alright, so let's now demonstrate how we come up with this value through an example. So suppose the cost of capital of the firm is 12%, right? Then the maximum PE multiple you should give to such stocks, as we said, is 1 divided by the cost of capital. So 1 over 12% is 8.3 times. Or suppose the cost of capital is 15%, then the maximum PE we would give would be 1 divided by 15%, or 6.7 times. Likewise, if the cost of capital was 10%, then the PE would come to 10. So it's a very simple calculation. So the way we would do this, we would find out if the company's return on capital is higher than its cost of capital on a sustainable basis. And then the maximum earnings multiple we should give the stock is 1 divided by the cost of capital. So some assumptions we have to make in order for this to hold. So the profit of the tax, or the earnings of the firm, should be the same as the adjusted earnings, right? So earnings power value gave you adjusted earnings, right? And in this case, we've substituted profit after tax, or just earnings, with adjusted earnings. The second one is that the company is either debt-free or its cost of debt is the same as its cost of equity, with the interest expense being non-tax deductible. So essentially, when we're looking at the cost of capital, that's taking into account the capital cost for the entire firm. When we're looking at the PE ratio, we want to think about the cost of equity capital. So we need to make sure that these are around the same. And once we factored in these two assumptions, the expected PE of a stock with stable earnings and a return on capital higher than the cost of capital is the same simple formula that we've already seen, right? The expected PE would just be 1 divided by the cost of capital. So here you can kind of nicely see how the PE ratio is really just an extension of the earnings power value method with a couple of additional assumptions. Price to earnings multiple approach. So now suppose we don't have constant earnings, right? So previously we looked at the situation where the firm has no growth in earnings over time. But what about the cases where the firm has a competitive advantage as well as growth in earnings? So to find the ideal PE multiple for this type of stock, we have to turn to our last of the three valuation methods, i.e. the present value method, or the franchise value plus growth. So here let's look at the formula for the present value method. So we had the capital base times the return on invested capital minus the growth rate divided by the cost of capital minus the growth rate. Now if we plug in the observed values for return on invested capital, for cost of capital and for growth rate, we get the intrinsic value of the firm as a multiple of C. Right, so we could plug in ROIC, G, and R, and we can solve for PV as a function of C. Now, invested capital can be expressed in terms of adjusted earnings by the formula earnings over return on invested capital. Right, so when we actually calculated C to begin with, we actually did it as the earnings times the return on invested capital. So earnings divided by return on invested capital. So we could essentially get C and replace it with E over ROIC. So what we end up with then is the intrinsic value of the firm expressed as a multiple of its earnings. So we get PV is expressed as in terms of E. And that's ultimately what we want in order to be able to find the ideal PE ratio, right? Because then the present value, that gives us the ideal price per share. If we have it in terms of E, then we simply have to divide it by E, and then we'll get the ideal PE. Price to earnings example. So let's look at an example to make things a little bit more clear. So suppose we have a firm with a return on invested capital of 20%, a growth rate of 6%, and the cost of capital of 12%. So if we substitute all of these into the equation, and we don't substitute for C, okay? So we just get PV in terms of C. We get PV equals C times the numerator, which will be ROIC of 0.2 minus G 0.06 divided by cost of capital 0.12 minus the growth rate 0.06, and then we get PV equals 2.33 times C. So now what we need to do is replace C with E over ROIC. Okay, and again, we use ROIC of 0.2 that we have here. If we replace C with E divided by ROIC, then essentially all we need to do is then solve for P divided by E, right? So we'll actually get PV equals 11.7 times E. We then take PV divided by E, and this will give us 11.7. So thus the result for an ideal PE firm with the ideal PE for a firm with the characteristics we've just discussed is around 11.7 times, or we can round this up to 12 times. So if we know the long-term expected return on invested capital and the growth rate, we can calculate the approximate PE that the stock can command after taking into account a suitable cost of capital. Okay, so again, you can clearly see how we, very nicely link, the PV valuation method to the price to earnings example. And one other thing to note is that this formula does not work if G is bigger than ROIC. Okay, So if our return on invested capital was bigger than the growth, if our growth rate was bigger than the return on invested capital, we would have negative numbers. And but fortunately, this is not a problem, because for all firms, or most firms, long-term growth on a sustainable basis must be lower than return on invested capital. It won't be feasible for a firm to have that level of growth over the long term, so it would always be the case that G is going to be less than ROIC. Summary of multiple-based valuation. So the beauty of the present value formula is that it can be used to arrive not just at approximate earnings multiples, but also multiples like price to book value and enterprise value over earnings before interest and taxes. So if the company under consideration is debt-free, then C effectively becomes the book value of the company, and the ROIC becomes RONW, or return on net worth. And then the PV that we get is nothing but the intrinsic value by way of the book value multiple of the stock. So as you can see, there are a variety of ways we can further manipulate the present value formula, and we can come up with all different kinds of multiples just based on that. We've looked at the price earnings ratio as an example, but we can do this with any of the other multiples. And the key thing to know is that we always want to make sure that our assumptions that we're making about the company are satisfied or make sense to us whenever we're using any of these methods, right? So if we're using the PV formula to come up with the ideal PE ratio, or price to book, for example, or EV over EBIT, we want to make sure that the assumptions that we've made for using the present value formula are satisfied, right? Meaning that we have return on invested capital significantly higher than the cost of capital on a sustainable basis, and we also expect earnings growth on a sustainable basis as well. Okay, so always remember, all of these valuation methods have certain assumptions behind them, and we want to make sure that we use the right method, right? So the assumptions that we're making are well suited to the company that we're analyzing. Okay, so this brings us now to the conclusion of our lecture on franchise with growth as well as multiple-based approach to valuations. Conclusion. So in this lecture, we have discussed a formula that needs to be brought into use when the firm under consideration has both growth as well as a sustainable competitive advantage. And then we saw that the present value varies with different combinations of ROIC over R and R over G, with valuations getting higher as both ROIC and G increase. And this should make intuitive sense, right? If return on invested capital is going up, then that means the firm is making more for every amount it invests. That should lead to a higher valuation. As G goes up, that is the firm's earnings growth increase, that should also lead to a higher valuation. And we also then use this to arrive at multiple-based approaches to valuation using the same PV formula that we studied in the first part of the lecture. So we nicely kind of connected the present value method with these multiple-based valuation methods. And we now have approaches to value practically all kinds of firms. So firms, for example, that earn less than or equal to their cost of capital, firms that earn more than their cost of capital but with stable earnings, and lastly, firms that not only earn more than their cost of capital but also have stable long-term growth in earnings. So we can put different firms into each of these categories, right? All firms are going to fall into one of these three categories, and we now have approaches to value all of these types of firms. So we should also remember that firms that grow their earnings at a strong pace but do not earn more than the cost of capital do nothing but destroy value over a long-term period, right? So if a firm's cost of capital is if a firm's return on capital is less than its cost of capital, even if we have growth in earnings, the firm is still destroying value, right? Because it's costing the firm more than what it's actually getting in returns. So we would want to always avoid such companies unless they're trading at a significant discount to their asset value. So to value this type of company, we would use the asset-based valuation method, and if it was trading at a significant discount to asset value, only then would we want to invest in the company. So in the upcoming lectures, we're going to look at some examples, right? So we'll actually look at some actual companies and we'll look at some financial statements and see how we do these valuations in practice. And then this should hopefully further solidify your knowledge of these valuation methods and give you a much better understanding as we see them through examples. Okay, so thank you very much for listening, and we'll see you next time.